Hi there, I'm James Preston and thanks for tuning in to Kalkine Media. With the backdrop of the ongoing pandemic and an erratic market over the past 18 months, there is an undercurrent of stagflation concern. And in this video, we'll take a look at what the signs of stagflation are and whether we're headed down that path. But before we do so, please make sure to subscribe to the channel and press the bell icon to be notified of the latest videos. In economics, a higher GDP growth means that people in that country have more income. A higher income leads to more spending, which in turn increases the prices of products, and that leads to a spike in inflation. In contrast, when a country's economy slows down, the rate of increase in income dwindles. This would ideally truncate the consumer spending, resulting in a lower demand and a subsequent price fall. But if we imagine a situation where the GDP growth of a country slows down constantly, but inflation keeps rising to uncomfortable levels, that's what stagflation begins to look like. And it's not pretty. At the onset of the COVID-19 pandemic, Victor Lee, a professor of economics with the Villanova School of Business, spoke about how he was worried about potential stagflation after the pandemic, a concern which was largely ignored. However, last week, as inflation prints of the countries across the globe started coming in, many have started feeling that we are in a stagflation phase. The numbers that are coming in, or are expected, are records in themselves. In China, factory gate prices in the month of May rose by 9%, their fastest annual pace in over 12 years, owing to the surge in commodity prices, highlighting the global inflation pressure at a time when policymakers across the world are trying to revitalise the post-pandemic growth. In the US, the world's largest economy, consumer prices for May accelerated at their fastest pace in nearly 13 years, as inflation pressures continue to mount in the economy. The rise in consumer price inflation is more worrying because it metes out a direct blow to the common man. Something that partly explains the current scenario is the fact that the prices are bouncing back from the pandemic lows seen last year. But that argument doesn't hold much water. The global prices were at their lowest in April 2020, when crude oil prices crashed into negative territory for the first time in recorded history. Given that logic, the inflation print should have come down in May 2021 compared with April 2021. But it has been otherwise, throwing the price recovery question out of the window. So, rising commodity prices are leading to an increase in inflation. But on the other hand, after a swift V-shaped recovery for most economies, the growth has started to slow down across all these countries. So it is entirely possible that we might end up being in stagflation if this trend continues over the next couple of months. So the big question is, what is stagflation? Stagflation is characterised by slow economic growth and relatively high unemployment, or economic stagnation, at the same time accompanied by rising prices. Stagflation, to put it simply, can also be defined as a period of an increase in inflation combined with a decline in GDP growth. Stagflation occurs when central banks expand the money supply at a time when the government policies constrain the supply. The most common culprit is when the central bank prints currency. It can also occur when a central bank's monetary policy decisions create a lot of credit. Both lead to an increase in the money supply and create inflation. At the same time, some other policies slow growth, just like an increase in taxes. Increasing the tax rate leads to a decrease in the disposable income, resulting in a drop in the growth rate. There are chances of stagflation when the central bank raises interest rates. The increase in the interest rate prevents companies from accessing more and more credit, stopping them from producing more. In a way, this is a result of expansionary and contradictory policies. Conceptually speaking, stagflation is in complete contradiction to slow economic growth, which would likely lead to an increase in unemployment but should not result in rising prices. Therefore, this trend is a dangerous one. An increase in the unemployment level results in a decrease of consumers' purchasing power. In simpler terms, it means that the money held by people is losing value as time goes by. This ultimately leads to people having less money, which is in turn worth less. Unfortunately, there is no foolproof cure for stagflation. However, most economists believe that it can be addressed by dealing with the supply side issues, that productivity has to be increased to the point where it would lead to a better GDP growth without any further increase in the inflation. This would give space to the central banks to tighten monetary policy in a bid to rein in the inflation component of stagflation. However, it's easier said than done. so it's better for economies to avoid it at any cost. If you've enjoyed the information contained in this video, then make sure to like, share and comment on the video, and subscribe to the channel and press the bell icon to be notified of the latest videos. For more information and regular updates, please head to the website kalkinemedia.com. I'm James Preston for Kalkine Media.